Welcome to tax season, homeowners. This one's for you. We're going to talk about all the benefits to doing your income taxes as a homeowner, but I want to draw your attention to one thing. Most people just take the standard deduction and kind of go through it. And if you do that, I want you to consider, depending on your mortgage amount and the amount of interest you pay, that alone could be enough to match that standard deduction and be reason to take a look at itemization. That and more next. What's up, guys? Jeremy Kane, eXp Realty here. Thank you so much for tuning in today. Please like, comment, subscribe. We're just gonna get right into this because the tax benefits of a homeowner are, pretty awesome. And the truth is that doing our taxes, definitely not that fun. And I totally understand that. But with these deductions, you can definitely have a little bit better time when you're doing your taxes. So first and foremost, we're going to talk about the primary residence. And the big things that you can deduct from your home are your property taxes and your interest. So when we're talking about property taxes in the state of Colorado, your taxes are paid in arrears, and there might be a year where you don't have the benefit of writing your taxes off, your property taxes off on your income taxes because you didn't pay them. So what happens is you pay your taxes for the year that you are currently in next year. So currently February, our first half of our property taxes was due. Most people have that in their mortgage escrow. The mortgage company just pays half of the 2022 taxes today in 2023, and then the next half will be paid in June of 2023 to finalize the 2022 payments. So if you do not pay taxes, property taxes, you do not get the deduction. However, once you do pay those, so it might take a year to kind of get that because sometimes the title companies just pay it off if it's late in the year and all the things. So once you actually do pay those out of your pocket, then you do have that opportunity to deduct that from your income taxes. Okay, so next we have interest, and this is the big one. And as I mentioned in the start, this is something that really can take your standard deduction and make it a reason to itemize. So let's take, for instance, a $550,000 home that you bought for 5% down. That's about a $523,500 loan. So on that loan, because interest is calculated on your loan amount, the first year, your interest paid is $25,917 at a 5% interest rate. So if you think about that, as a married couple, the standard deduction is $25,900. So that's almost right at what it is at a $523,000 mortgage at a 5% interest rate. So if that's you, or you're above that in your interest rate, which is possible these days, or you have a higher loan amount, you may really want to take a look at the interest that you paid before you just check the standard deduction. If you're not married, filing single, your standard deduction is only $12,950. So that kind of plays in a role. So if you could think about that, halving all of that, you're probably there with a $325,000 mortgage to cover that standard deduction, and then all of a sudden you can itemize and start get the benefits of itemizing and writing some other things off as well. So that's just something to consider. As I said, I am not a tax accountant. I'm not a tax professional. So make sure that you consult with your tax person when doing any of the things I'm going to talk about. But I just wanted to kind of point that out as something, as a benefit to maybe consider, and just one of the great reasons to own a home. And we're just talking about the primary residence. So the tax benefits really get exciting when we're talking about a second home or investment property. Now, a second home, you can only write the interest off for one of them. So understand that piece, and you guys can talk about that with your tax professional. But let's really dive into this income property thing. The first benefit is depreciation. At some point, someone decided that a home depreciates over 27 and a half years. So each year you can take one portion of that and deduct it from your taxes. So 27 and a half fifth I don't know how to say that, but it is what it is, right? So one portion of that amount you can deduct from your taxes on the total value of the home. Now you are supposed to adjust for land, and I'll leave that to the tax professionals again. But this is a huge benefit, if you will, because you depreciate and you're writing off the depreciation, and the value of the home is usually appreciating. So that's pretty cool benefit there, and definitely make sure you're dialed into that, because depreciation is actually also recaptured in the form of capital gains if you were to sell the property and cash out the property and go somewhere else. So that is something to also consider, is when we talk about capital gains, you have the actual gain. So if I bought a home for $100,000 and sold it for $300,000, my gain would be, my taxable capital gain would be $200,000. And also if I was depreciating that over the previous year's taxes, then that is also, recoverable to some extent. So definitely make sure that you're aware of that. And the thing about all of the capital gains is the 1031 code, which basically allows you to take your proceeds from an income property, put them with an intermediary, a 1031 exchange intermediary, and then they can basically divert those funds to your next purchase of a like-kind property. In fact, I closed one of those today for a client, which is pretty cool. So essentially, if that is done, and say you were taking depreciation on the original property, as well as you made, an appreciation of $200,000, well, the next, if you take it to an intermediary, and if the minute that you walk away with the check, that technically is not allowed. So make sure that you're going through a 1031 intermediary. There is a fee. It's not crazy for the savings that you're going to get. And then they wire the money to the next like-kind property closing. And so once you do that, then you're just kicking the can down the road, or you're deferring the capital gains. Now, currently, the tax code allows you to, you do have to rent that replacement property out. And there are some other rules about time and all of those things. This isn't a 1031 lesson, but you do have to make that an income property. It has to be like-kind for 2 years. But say you decided to move into it at some point and turn it into your primary residence after those 2 years, you're able to do that. And then if you lived in that property for 2 more years, then technically you're selling a primary residence, and then you can capture all the benefits of that and not worry about the capital gains. If you're doing this, I highly recommend talking to a real estate agent that knows what they're doing, and a 1031 intermediary, as well as your CPA. Make that your A team and make sure you're doing everything right. Everybody's on the same page. The person preparing your taxes, the person helping you find the properties, knows the time limit, and the intermediary, who has to be involved as well and kind of makes the rules. So they'll keep us all in line, I guess. So 1031 exchange is absolutely something that's a remarkable option, and some ways to defer or turn that like-kind property at some point in the future into a primary residence and take advantage of that piece of the code. The next is your Schedule E, and this is the document that allows you to write off a lot of things when it comes to an income property. So not only can you write off the maintenance and upkeep of an income property, you can also write off the interest for all of those mortgages, as well as the taxes, as well as even the mileage to travel there. So that's something to really consider. Now you say, well, why did you, kind of highlight, the interest there? Well, if you have your primary residence and a second home, those are the only two that you can write the interest off on as far as your usage of the home. So, and the primary residence, I think all of them have a $750,000 loan amount cap. So you can only write your interest, up to the $750,000 loan amount. So if you have $1 million loan, you can only write off, 3/4 of the interest that you paid. However, the in investment properties, you can write off the mortgage interest for all of your investment properties, which is pretty cool. All your taxes. Another thing you can put on your Schedule E is your homeowner's insurance for those investment properties. You cannot write off your homeowner's insurance for your primary residence. So as you can tell, there's so many benefits here to owning income properties as we kind of go down the road and you really look into it. So I tell people it's reason 999 why owning a home is better than renting. We often, list a bunch of things, but then we skim over the piece about the taxes, right? And clearly there are so many benefits to owning versus renting, but the taxes may be one of the biggest, especially if you're going from a standard deduction to an itemized reduction. So just something to keep in mind when you're having that conversation is the taxes, because taxes are completely separate usually from the conversation that we're talking about. But just the tax savings alone is incredible compared to the difference in rent and mortgage. Obviously rent sometimes a little cheaper than mortgage overall on the day of, but when you take a bird's eye view, there's other things that come into play: principal buy down, appreciation, and taxes. So just keep that in mind when you're looking at that. The next thing is, obviously, when we're talking about itemization and all of that, make sure that you're being smart about this. If you're in a position where you're going to be buying homes and moving up and doing the things, especially as self-employed, you're going to want to make sure that you're not deducting too much and you're taking away your income, because especially self-employed, you need 2-year average of your income. So you don't want to completely crush your income by taking all these great savings that I talked about here. And, then obviously you're going to buy your house or buy a first house or maybe buy your move-up house, and you don't have enough income to support the loan that you're going to need because you've taken all these fancy deductions. So obviously if it's your first house, you haven't taken the deductions, but you get what I'm saying. So I hope that helps kind of dial it in. If you ever have any questions about this, I would be happy to connect you with my accountant, very knowledgeable about all things, especially involving the real estate space. And again, I am not a tax professional, not an accountant. I'm a real estate agent looking to serve you. And I just thought it was very interesting, all of these kind of benefits that have come up and, constantly are kind of on my mind, kind of the echo effect, right? People are asking about this one or that one. So I wanted to bring that to you. If there's anything I can do for you, if you have any questions, please comment below. Would love to touch base with you and make sure that you are maximizing all of your deductions on your taxes, because we all know that we pay a ton of taxes and, it's part of the game, but the less we can pay due to the things that we're investing in is always good. So as always, Jeremy Kane, eXp Realty. Like, comment, subscribe, and we'll see you in the suburbs sometime. Bye-bye.